Ramesh Iyer, MD and VC at Mahindra and Mahindra Financial Services, joins us on the show right now to talk about how their quarterly performance was. The stock, of course, on a tear, holding up almost 4% as we speak right now. Ramesh, hi, morning. Your loan book has grown at 25% in the third quarter, but it is slightly slower when you compare it to the pace of growth that one has seen in the last two quarters. What are your expectations going forward?
Whether the growth is at 25, 27 or 20 odd percent, I won't see it as a slower growth. And second is one should also look at it from last year's third quarter. What was the overall disbursement and growth versus how is the disbursement and growth this year? Last year also was a very big base. So honestly, we're not as concerned about 1 or 2% here and there. It doesn't really matter so much. In as far as the segmentation or the segment-wise growth or classification of growth that we are expecting from, I would think that the rural market is still doing pretty well. The vehicles are on demand. The footfall at dealerships are very, very high. And yes, tractor has probably been the slowest in terms of all product put together growth. But for us, even in tractor, we have had a decent growth because of simple reason that we have spread across the country. So I would more look at it as, is there any geography from where the growth is higher than any other geography? I think we are seeing pretty uniform growth across. And so far as product is concerned, I would think pre-owned vehicle probably would go faster than any other segment.
Right, morning. Now, you had also guided for an AUM growth of 20 to 25% in FY24. What are your expectations for FY25?
At this stage, we are not relooking at, lowering our growth potential. My belief is also that while there will be, a volume growth which would come, but I also expect during the FY25, there would be some price increase that would come from the OEMs. And if that was to happen, I think the growth rate would be, well maintained because of the volume and the price both coming together. And you would have seen from our interactions also that we are also gaining some market share in some of the product, and that should also add up to our overall growth. So at this stage, we are not really downward trend towards our growths.
Right. You briefly, Ramesh, touched upon the tractor segment as well. Last quarter, most of your segments, barring tractors, did perform well, and you were expecting a pickup in the second half. Is this panning out as per what you had anticipated?
I think tractor at the back of good infrastructure story, I still believe should pick up well. Yes, from the farm side, the growth rate has come down, but clearly on the infra front, we are still expecting that the growth rate would come. And we see that even in the construction equipment side, the demand is pretty much holding up. And if the construction equipments are holding up, tractor also plays a good commercial role out there. So my expectation is still, and that's why I said in the second half, one should see. And maybe in this quarter or even going forward, I still expect that the haulage application tractor pickup would be there.
Mr. Iyer, what about the performance of the used vehicle segment? Last time you joined us, you suggested that there were some supply side concerns for the entire industry. Has the situation improved now?
Not yet. I mean, see, one of the supply comes from vehicles which get repossessed by the financiers. And the collections have been very good on its own. So therefore, the need to really repossess has been very low. And therefore, the supply side continues to remain a constraint. But I think exchange programs have picked up. That's the other source of supply for pre-owned vehicle. And if the exchange programs do well, the supplies would start to improve. But the demand definitely is much higher than the availability.
Right. So you've unveiled plans to enter the insurance sector via partnerships with a few insurance providers. What's the rationale here and what's the opportunity that you see?
So it's a very large opportunity. We have a very large customer base and we are acquiring every month close to about 70, 80,000 additional customers, and all of them do look for good insurance. So far, we were operating through a broking network that we have. We also see a direct correlation that's possible to work with this customer through an agency approach. So what we have really kind of approached the regulator is to get an agency license. And if we were to get that, then we would work with select few insurance companies and take that product forward to our customers across. And the second year, third year insurance also becomes super important, the renewal of insurances. So if we are an agent and play that role extremely well, our belief is that we can really penetrate more deeper into the market and can also at some stage start working with the insurers, help them design new product requirement for this market, and that would become clearly a growth potential. So overall, I think that the penetration would improve. Products that can be made available will also undergo change, and that would help a larger customer base that we work with.
Now, your borrowing costs have also risen higher than expected for the quarter gone by. With banks now rationing credit, what is the outlook on your cost of funds trajectory?
So at this stage, the cost of funds is still not coming down. Fortunately for a company like us, liquidity is never a problem. Availability of funds has never been an issue, and it doesn't seem to be either. We are also a deposit accepting company, and therefore we resort to all sources of borrowing that's possible. But as we speak, definitely the interest rates have still not come down. And the expectation is that at least in FY25, one would start seeing that climb down. And therefore the interest rates remains elevated. Good news for someone like us is that we have a lot of PSL kind of lending that we do, and those qualify for some concessional borrowing as well. And therefore, we've been able to contain the overall increase in our borrowing cost, but nevertheless, they still remain elevated.
Right, and a standout factor this quarter has also been the improvement in your NIMs. Last quarter, one observed a sharp contraction because of the rise in borrowing costs. Does this improvement reflect the repricing of the portfolio, and what portion of your book is yet to be repriced?
So one is our book is a fixed book, so therefore we can't reprice the book. Only new lending would come at a new price. Clearly, the improvement in NIMs, one, of course, is the new lending has been done at an improved rate, which we talked about in the last quarter. And we had expected that our NIMs will go to 6.8, and we are around there. The other reason is also the product mix change, which we have talked about. We definitely saw increasing trend in the pre-owned vehicle disbursements, and they come at a different yield. So that's the other factor. And the third factor is we have gotten some fee-based income which have started coming in from the customers. One is, of course, from the insurance front, which will further improve and once we get the agency license. But also there are, other cross-sell opportunities that we've started doing with our customers, though in a small way. So it's not any one action. It's a mix of 2 or 3 actions which have gone in together for the NIMs to improve, and you will see this trend even going forward.
All right, and how will you look at evolving your NIMs evolving over FY25?
So we said that, we were at 6.6. If you recall the previous quarter, we said we'll move to 6.8 and then we'll move towards 7. I think this is through our actions. Our belief is that the borrowing cost starts coming down next year. That should also help us get at least 10-20 basis point further improvement. So I think once the borrowing cost comes down, one can expect a NIMs anywhere between 7.1, 7.2. Until then, we would be very comfortable to state that we'll go up to 7.
Right, and how about the asset quality? How's that shaping up on the incremental book? The credit costs have improved to about 1.25%, which I guess is lower than your guided range of 1.5 to 1.7. At what level would you end the year?
So definitely what we've committed to is definitely doable, and the trends are very clearly visible. And one should look at it from 2 or 3 angles. One is the collection efficiencies have held up very well, upward of 95% plus. The second is, if you look at our stage 2, that has also remained pretty stable or gone down, which means the forward flow is not happening. So if you look at stage 3, stage 2 together, they are at sub 10% level, which is one of the best historically one looks at that number. So these 2 or 3 indicators very clearly tell us that the credit cost is well under control, and we are more than happy to commit to what we had said that we would be at the year ending. We don't see that a problem. And I also touched upon, if you recall, said that the repossessions have gone much lower because the collections are much, much better, which also leads to lower termination or a disposal loss, which used to be one of the factors of the past when you settle accounts by taking back assets and sell them. That's not the requirement any further. Put all this together, we are pretty confident to kind of say that the range that we have committed to is a very easily doable task.
All right. And while the company is progressing well towards your Mission 2025 growth, your ROA is under a bit lower than the stated guidance of 2.5% because profitability has been impacted. So are you still on track for this guidance, or will you be revising it?
I think our first target would be to reach the 2% before we speak of 2.5, because the borrowing cost has been something that's dodged us. Right. When we put out the 7.5, we did not expect the borrowing cost to be where it is, which means our NIMs have come down, and we talked about NIMs, how it's likely to improve. As the NIMs go back to a 7.2, getting to a 2.5 is a doability. Until then, when the NIMs are at 7, one should expect that the ROA will also be anywhere between 2 and 2.1 or so. The other area where we are really focusing to bring down is our OPEX, which is at 2.8, and we have guided to say that we want to bring it down to 2.5 in a year or so. And we would be comfortable to at least believe that 2.8 will come down to a 2.6 before it can go down. So if these 2 or 3 actions do pan out, then we would reach the 2.5 that we are talking of.
All right, good to have you on board. Thank you so much for giving us those highlights. That's the view coming in. Rural market is doing well, and NIM improvement trend will only continue.